Hello, everybody. Welcome to ETF Edge, your go-to place for everything ETFs. I'm your host, Bob Pisani, and I'm joined today by a trio of splendid guests. Tom Lydon is the head of the ETF Trends. Todd Rosenbluth is at CFRA, and Jason Bloom is the director of global macro ETF strategy over at Invesco. Thank you all for joining us. It's oil ETFs again, folks. We talked about this last week. USO changing its stripes again today with the front month futures contracts changing. Jason, I want to start with you. Invesco runs the Invesco oil ETF, the oil fund. It's just symbol DBO there. That's the main competitor to USO out there. Can you explain to us a little bit about how this works and how, if any way, it differs from USO to us?
Sure. So USO and DBO are similar in that they're both ETFs and they both hold WTI futures contracts, but that's about where it ends. DBO, since its inception over 10 years ago, has always used an optimization process in selecting which futures contract to own. Occasionally, they own the front part of the curve, which USO used to own exclusively until the several changes recently. As you mentioned, now they're spread out across maybe the first 3 to 4 months of the futures curve. DBO, before every futures roll, looks 1 year out the curve and makes a calculation as to which futures contract offers the best annualized roll yield. In other words, the best cost of carry. In some cases, it's actually positive income if the futures markets are backwardated, downward sloping. Obviously, we're in contango. Super contango is a word that we've seen bandied about. But essentially, contango means that there's a negative cost. There's a cost and burden on the investor to hold that futures exposure over time. DBO seeks to minimize that cost in the contango market. We currently hold the March 2021 futures contract, which is pretty far out the curve, and it hasn't really been subject to some of these issues we've seen in the front of the curve.
Well, I love this word optimization process. Essentially, it's a rules-based thing, right, where you're trying to minimize the effects of contango. But I wonder, how could you make money? I mean, given that the whole curve is essentially in contango, how do you, maybe you can avoid losing less money. Is there actually a way to make money, assuming you just invest a certain amount and stay in? Isn't there a real danger, even in the way yours is structured, to just buy and hold strategy? Is that even advisable?
Well, it really depends on what the investor's expectations are and what their time frame is. So funds like USO give you a high sensitivity in the short term to daily moves in price crude. Well, used to until today. Now that sensitivity's declined. But the whole idea was it was a good trading vehicle for short-term traders. If your view is that crude oil is going to move in one direction or another, in this case higher, over, say, the next 8 to 12 months, DBO, you can look into that, and in a contango curve right now, you know the DBO owns the March 2021 futures, and it will hold that futures contract until about a month before expiration, about 3 weeks. And then it will, again, do that optimization calculation and then make the roll. So you have a great deal of transparency as to what your exposure is going to be in DBO, and then you can do the math. So if you buy DBO today and that futures contract is $29 a barrel, you know that if you're above $29 a barrel minus management fees, you have a chance to profit from that. So it just depends on your expectations and your time frame.
One of the things that's disconcerting about USO is they seem to be changing. You don't really know what you're investing in at any time with USO. Would I know at any one time what I'm investing in DBO? Is it predictable from month to month that you're going to be rolling over into certain contracts that are 9 months out, 11 months out? Predictability is important here, obviously, if you've got an opinion on oil.
It is. We think it's the best balance between predictability, transparency, and having some sort of dynamic optimization. So you have transparency that DBO's index is going to hold that, and DBO's purpose is to track that index, right? It's going to hold that contract until right around February 1st. Then, depending on the shape of the curve, it will roll to another futures contract. Now, if the curve for some crazy reason ended up in backwardation, it may just roll from March to April and collect the highest possible roll yield. If we're still in a contango market, it will likely go further out the curve to minimize that contango again. So
the answer to this question
up until the roll date. Yeah. Sorry.
Right. So the problem here is it's rules-based, but you can't really predict exactly what you're going to do. I understand your point. And Tom, Todd, you guys jump in here. You're old hands at this. You've been seeing what's going on with USO here. They changed the investment methodology probably 4 times in the last week and a half. They're now not investing at all in the June contracts. They're only in the July conference. So today, and presumably the next 2 days, they're selling that June contract. One reason I think oil futures are so much under pressure, and they actually own a June 2021 contract, or will be owning it. They've announced. I guess, Tom, what is there something to be learned by all of this? We've obviously had a bit of a mess here. I guess what I'm concerned with is, should ETF investors sort of know a little bit more about the dangers of investing in commodity pools where you've got this contango issue? It seems like we had an awful lot of retail people invest in it, even though the dangers of doing this have been known for a long time. Tom?
Yeah, absolutely, Bob. You hit the nail on the head. I think a lot of investors were thinking that in buying USO, they may be able to profit from future oil prices when people start driving cars and flying in planes again. But what, in fact, they bought were people not filling up their tank and a bunch of tankers full of oil sitting off the coast, and it didn't translate to them. So to your point, you got to look under the hood. What Jason is saying here is we're in a situation with DBO where in buying that March 2021 contract, there's a much better chance that if we do get a recovery in the economy, that those that are investing may be able to participate in that rebound. But if they don't happen to hit it dead on, they can go forward into other contracts down the road once we get closer to that March 2021 date.
Right. Todd, I guess just pushing this question about warnings to investors, some have argued that essentially, you're buying futures contracts here. If I wanted to open an account at Ameritrade and trade futures contracts, I'd have to sign a FINRA statement saying, oh, yeah, I know exactly what I'm doing and I could lose money and they could go negative and all a disclosure. But you don't have to do that owning these. Should there be some kind of, should people who are supervising these, the SEC, or perhaps the financial firms themselves who are selling these, be required to do some kind of disclosure or have more education here? I'm trying to get at the point of avoiding this kind of mess with the retail investors.
Yeah, these kind of products that use futures are more dangerous for investors. It makes it harder for them to understand what they're actually owning. And just to drill down, USO and DBO have a 6 basis point difference in expense ratio. And if you look over the last 3 years, it's over 2,000 basis points in performance. So you really need to understand what's inside the portfolio, how these are different, and then determine if these are even appropriate for you and your client.
Yeah, it's a tough situation.